All right, mic check 1 2 1 2. Hopefully this thing is working. Um, so in the chat, my man Bode. First of all, I'm gonna give a shout out to all my Nigerian partners. If you Yoruba, Bawani. If you Igbo, Kedu. One king to another king. Yeah, Bodie got a question about cover calls. So what I'm gonna do is make a quick little video on cover calls to try to explain this concept to y'all. I'll come back with a more thorough explanation once I hook up my tablet and put something together. But he sent this to me today, so I got a little time. Let me go try to check it out. All right, so he said symbol was HPQ, right? All right, boom. All right, so here's the chart for HPQ. First of all, if I'm doing cover calls, it's not for like a couple of days. It's for a stock that I plan on holding for at least a couple of weeks, really more like a couple of months to a couple of years. Because what I want to do is get cash flow for that. That's the whole purpose of cover calls. It's like when we talk about calls for everybody that's new to options or just new to stock trading, a call is basically like a contract um, that you can buy and sell that gives you a right. Well, you know what? Let me go backwards. Let me go all the way back. First thing first, let me try to break down options to y'all. All right, so it's a couple scenarios, metaphors that I can use. The best scenario I can use. Hopefully, everybody has some kind of understanding of basic real estate. And if you don't understand real estate, I'm gonna make it so simple where you can think about anything. All right, so imagine if I'm selling my house, right? Let's say, look at somebody's name. Let's say Michael. Michael, if you know anything about a lease option, right? Say you can lease the car with an option to buy it, right? So we ain't gonna even do that. We're just gonna do straight buy the house, right? So let's say Michael comes to me and he says he wants to buy my house for $100,000. Those even number, 100,000. Now Michael thinks that the property value is gonna go up to 150,000 within the next year or so because of the World Cup. That's his thinking, right? So he puts a house to buy my he put a contract to buy my house for let's say um 30 days from now. To buy my house within 30 days for $100,000, right? I say, okay, fine. So here's what I'm gonna do. Since you want to take that long, what I want you to do is put down 4%, right? So the total value to buy my house is gonna be that 100,000 plus that $4,000 that he's paying for that contract, right? So, couple scenarios. Let's say time is almost up, right? And something happens in Atlanta, right? Let's say some kind of bad water leak that they ain't gonna be able to fix for 2 years, and it caused the property value to drop, right? So let's say now the average house in this area is only going for $75,000, right? Or let's say it's going for 60,000. Do it make sense for Michael to buy that house for 100,000? It don't, right? So what happens is he just lost that $4,000. At least he didn't buy the house for 100,000 and lose all the other money, right? So in that scenario, I'm holding the stock. I mean, I'm holding this house for a long term. So that just gave me some additional cash flow while I'm holding the house, right? So I still keep the house. The contract expires. The $4,000 stays in my pocket. but I still has the equity in the house, or I still have that asset, which is the actual house, right? Let's say it's another scenario. The same guy come back, Michael. They found out one nothing really wanted water. Now he want to do another contract. He want to buy my house again for $100,000, right? I tell him, okay, same deal. Give me $4,000 for me to hold his house for 30 days for you, right? So regardless, I that $4,000 is mine, regardless of what happened. You got me? So let's say found out it is a hoax. Ain't nothing wrong with the water, right? And the house jump up in value to $150,000. See all these houses around here going for $150,000. Now, Michael got a couple of options. Listen to what I said. He got a couple of options. He can go ahead and buy this house, right? He can buy this house, even though it's going for 150. Me and him got a contract. We got a deal. Keyword contract. Saying that he can buy my house for 100,000. Well, he buy my house for $100,000, right? Because that's the contract. Plus the 4,000 I already put in my pocket. Now it may seem like I lost, but not really. Especially if I paid less than $100,000 for the house. I just missed out on the other money I could have made. But I locked in that 104 price, right? So I got that $4,000 additional profit. What he can do is buy that house and keep it now and keep the equity. In other words, they call it intrinsic value. He paid $104,000 for my house, but now he got $45,000 worth of equity. Key words, equity. You're gonna hear these words again when I'm dealing with these stocks. So the other option he could have did, here's the other thing he could have did. He made the right assumption that my asset, which is my house, was gonna go up in value. And it did. It went up in value to 150,000. And he had me locked in on a contract saying that no matter what, I gotta sell it to him for 100,000. Guess what? Let's say he moved to Texas. And he like, I don't want that house. But I know that this contract is worth some money, right? He paid $4,000 for this contract, for this piece of paper. But now this piece of paper is worth $50,000, right? Because it got that much equity in it. So all he got to do is go to somebody else. Let's say he go to Raheem. Raheem say, man, get about the house. I give you 15, 20, I give you $20,000 cash right now for that contract. That contract is still good, even though it's between me and this other guy. It don't matter. It's a contract. So he can sell the contract. So his $4,000, what I say, you're gonna sell it to him for 25,000, right? He just made $21,000 profit. That's what's going on in these options with these contracts. So what's happening is this: if you own at least 100 shares, then you can sell a contract against those shares, just like a house. So if I had like in the group, y'all heard me say something about Netflix. I had a couple of sold a couple of contracts, right? So that means I had at least 100. Could have been a couple of hundred. I ain't gonna get into the detail, but I had at least 100 shares of Netflix, right? What that means is I can sell somebody a contract to buy that 100 from me for a certain price, right? So what I did, I paid like 80,000. What is it? 83. I paid $83 per share for the Netflix, right? Follow me? So let's say per $100, that was like $8,300. Netflix went up to like 90 something, right? Once I was up a certain amount, I was like, cool, let me lock my profits in. I didn't care if it went to 100, 110. What I did was I started selling contracts right then for like 2 weeks out, saying that um somebody bought a deal for me, basically saying that they would pay even more for what I paid for it, guaranteed no matter what the price do. Now I didn't like the certain price action, so I said, all right, run it. So I sold his contracts because I actually own the stock. I'm covered on that. Just like I own the house, I can sell a contract against my house. Since I own those Netflix shares, I can sell that contract for somebody else to buy these shares from me. And that's what I did. That's what you call a cover call. So a couple things can happen. Just like the house, what can happen is this. Let me give you some baseline numbers so it'll make sense. Let's say if I pay 83, right? Let's round up to a good number like 93, because I think I sold something at 93. All right. So at $93, when the stock got up to $93, I sold a contract for like $1,000 to buy my 100 shares at $93, right? Because I felt like, hey, okay, I think Netflix gonna pull back a little bit. So what ended up happening was this. I sold a contract. They call it a call, right? When they're going up, it's a call. Going down, put that's a whole nother video. So I sold a contract for these folk to buy 100 shares of Netflix from me for $93. But I sold it for $1,000. That's just like how I explained the price of that contract. In other words, that lease option, that contract itself costs $1,000, right? Netflix went down probably like the next 2 days, right? That contract went down in value. Just like the explanation I gave y'all, if the house went down to 50,000, that contract ain't no good. It ain't no good to him. It's money in my pocket. So when Netflix went down, that $1,000 that dude gave me, I kept that, right? Actually, it was worth more than 1,000. But what happened was this: it went down about $1,000 in value. Let's just keep it at 1,000. It went down, and I just kept that contract. I kept the they call that a premium. Like, in order for me to make that deal, you got to give me $1,000 for this contract. Now, that contract, if it fell down to nothing, like, let's say time went by, it was about to expire, right? And Netflix was about $90, right? When it was about to expire. So what that means is ain't nobody finna pay. Let's say if the stock worth 90, nobody gonna buy this contract from me for $93 on that same day. It don't make sense. So because that contract went down and lost all its value, I kept that money in my pocket and then I did it again. That's it. And I don't want to hope this last part don't throw you off. But here's the other thing I could have did, and it's what I did a couple of times. If I say, all right, I know Netflix ain't going out for the long run, so let me just sell this contract against Netflix right quick. So this is how I do it. Let's say I sold another contract for 1,000, right? Let's say the Netflix go down, right? But that contract don't completely go to zero because you still got some time left on that contract. So when I sold it for 1,000, since the contract went down to like $600 right now in the market, I'll buy that contract back, right? I say I'll buy that contract back for $600. Well, I sold it for 1,000. I bought it back for 600. That's a $400 profit, and I'm keeping. Now I don't have obligation to sell my 100 shares to nobody. So that's a more advanced part of it. But that's basically how cover calls work. When I get a tablet, I'm gonna break it down. I'll let y'all respond to me to this video when you see it and see if it makes sense to you. So keep that in mind, man. I wonder, can I draw on one of these things? No, I can't draw right now. But anyway, and that's that. Now let's get to these charts. You asked me about HPQ. Uh, I don't know what's up with this stock, bro. Um, let me see something right quick. All right, so what I'm gonna do is use what I showed y'all in the book. You got something called RSI. Let's see. I got my own version. Let me give y'all. So what you see with these arrows right here, I got my own proprietary algorithm that I came up with. It's on my website. Well, this is the premium one. I got a simple one on the website, but if you notice, these signals are pretty on point. These signals, they not really after the fact. They pretty much tell you what's going on. But anyway, so looking at this, just looking at using my signal alone, it's okay for now. I like to buy when the first white arrow appear. Uh, okay, all right. So I see one good thing I like about it. This is a daily chart. So one thing, if you notice in the book, I told y'all it's a lot of stuff you can do with these charts and all that. But the main thing that I put people onto is the stuff that worked for me for years. This is how I grew my account to six figures account. Uh, got something called bullish divergence. You can do bullish divergence and bear divergence. So when the price is going down, but the RSI, that's a whole nother video I explain what it's about. Just know that this is how you use it. When this is going up, when the strength at which they buying it going up, but the price going down, this is what you call divergence. So it's going a different direction. This is a sign that the big money trying to come into it. So this is a pretty good thing. So what I would do, uh, let's say if I buy this, right? If I buy this particular stock right now, it's going for $20, $21, right? So it's $21 right now. So in order for me to sell a couple calls on this thing, right? I got to pay $2,100, right? Got me? So if you want to sell a couple calls on this, you got to spend at least $2,100 in order to sell one contract on it. All right, so if I want to buy one contract, it's $2,100. Now, this is what you would do. On Think of Swim, you're gonna click on this option chain. Let's see what these options look like. So if you look over here, this number right here tell you how many days they got until they expire. Remember I was telling y'all about how what happens as when that guy bought that, put a contract on the house, how that eventually that contract expires because you're getting closer and closer to the closing date. Or in other words, they call it expiration date. So what you're gonna notice is, let me pull up this thing right here, right? So this is how you read this thing. These are the calls, or these are the contracts you buy if you think it's going up. The put, if it what you buy when you think it's going down. If it's in the blue, that means it's what you call in the money. This right here is what you call a strike price. Just like you throwing a baseball, you're trying to throw strikes. In other words, you're trying to hit the target. So this is the target price. You got me? Right now, this stock is at $20.99. So this contract is for $20.50. So it's in the money, meaning that right now it's less than the market value. This contract that's $21, $21.50, and 22. All these are out of the money. So if you see somebody talking about OTM, that's mean out of the money. ITM in the money. You got me? If you get into the option, you need to know this stuff. ITM in the money, OTM out of the money. As you can see, it's the total opposite over here. These are in the money because you are expecting this contract when it expires to be less than 21. That's why these right here are in the money. These right here, you expect right now, these are out of the money, right? Why are they out of the money? Because the stock right now is worth almost $21, which means that right now it hasn't fell below $20.50 yet. So these right here gonna be worthless tomorrow. That's why they so cheap. This is how much they the people who trying to buy them, this is how much they going for. They trying to buy it for $1. All right. So even though it looked like it say 1 cent, it's $1 because you get access to 100 shares. So whatever number you see right here, you multiply this times 100, and that's how much it's gonna cost. For example, this contract costs $74. The people who own this share, like Bode, when he buy um 100 shares of this particular company, he can sell one contract that expires tomorrow for $74. Well, this is what the people who already own the stock is asking. The people who trying to buy it, they saying, nah, I ain't gonna pay all that shit. I only pay you $56 for it. So this is what's going on. You got the bid and you got the asking price. And the difference between is what you call the spread. You got me? Just because they look in here and they say that it said 56 is what they bidding on, that don't mean that you're gonna get it for that price. You might have to go ahead and pay this man what he asking for. And this doesn't just relate to stocks. This is how it is. I mean, it doesn't just relate to options. This is how it is in stocks as well. Bid and the ask. The more liquid, I'm using too many terms. Put it like this. The higher the volume of contracts that's for sale, the closer these two numbers will be. Right? The more you have available, the closer these numbers will be. If they not, then you got some stubborn people over here that say I ain't paying that much. Then you got stubborn people over here saying, well, I ain't selling it for less than that, no less than that. So now they stuck. You got to go ahead and put your order in somewhere in between, or just take what they offering. All right. So, Bode, if you want to sell a cover call on this for $2,100, right? If you sell one for tomorrow, you can probably get 74% for it, right? 74 cent. Let's see. Out of $2,100, $21 would be 1 cent, 1%, right? So you're looking at it's like a 3% premium that you'll get off this thing, right? That's like a quick 3% in a day, something like that. So as you can notice, now keep this in mind. We at 2050, right? Let's go out 30 days and look at the two contracts. You see how on here, this one says $74 per contract. This one said $191 a contract. Why? Because you got more time. As time go by, if this thing don't go up, then this thing drops in value. That's a whole nother lesson. That's what they talking about with deltas and all that. I'm not gonna even do that to y'all. You have to look that up online. If you still don't get that, let me know. I'll do a quick video, but that's a whole nother 30 minutes. Just know these are the strike prices. The reason these prices are for $20.50 contract, the reason they are higher because you got more time. That's it. You got me? So, Bode, if you want to willing to hold it for 30 days or not even that long, or just sell it for that price. So if $21 is 1%, 21 going to $2 or almost five, right? Let's see. So that's about 10. So you'll get about 10%. Yeah, that's about 10%. So you'll get 10% guaranteed right now. If you buy this right here, right, for 21, even though, well, nah, let's go to 21 because it's at 21. Let's do 29, 21. So at $21, if you pay $2,100, right? Um, let's see. 21 going to 20 going to that. Okay, that's about 7%. So you'll get about 7% guaranteed. Guaranteed. If that stock don't move nowhere else, you're gonna get 21% guaranteed. I mean, what I say? 7%. You'll get my bad, dog. The video getting too long. That'll be 7% that you're guaranteed to have if you buy 100 shares and you sell a covered call, not put covered call against those 100 shares, you'll get back 7%. 7% of $2,100 is $146. I got a calculator if you want to be specific, but you can check it with y'all phone. And I'm put the calculator out. Tell you what, is that boom, 6.9%. I just know math, bro. But anyway, so you get guaranteed 7% on that. And it's a guaranteed 7%. If you buy it right now today and sell it tomorrow, or let's say you buy 2100 right now, you put that 2100, get your 100 shares, you can sell a contract for 28 cents. That's shit. I don't even have to do the numbers on that. That's about 1 point something percent. So you can guarantee to get 1% between the day and tomorrow if you buy it and sell it. But if you hold it for like 3 weeks, 3 or 4 weeks, then you can get that 7%. And check this out: if you like the stock and it closes, if 3 weeks from now come by and that stock is less than $21, you keep that money and you keep your 100 shares. I'm gonna stop it right there. Hopefully, they made sense to you. Now, what I think about this stock, it's okay, man. I like the divergence of it. Um, I have to look at the fundamentals on that. Let me get back with you on that. I ain't gonna make another video for that because this video long anyway. But I'll tell you what I think about the fundamentals. But hopefully you understand what I mean when I say cover calls. And I know you got a copy of the book. Look at the book and review what I put in there about bullish divergence. And I'll send you a link to a video where I think I explained that. So yeah, man. If the fundamentals look good on this stock, I mean it don't have a 52-week high, look like of $30, which is 50%. So that's like a 50% gain. If you think you're gonna do what it do, cover call. If you're gonna do cover call to ride it out, now's a good time to do a cover call because let me show you something. Let me take this off. Now's a good time to do cover call because if you notice, just like in the book, I was telling you how to make these trend lines. If y'all don't know how to make a trend line, you go from the top of the counter to the next top and then just draw it all the way through. So it look like it's in what you call a little channel right here, right? So based on this channel, it look like it's at the top of the channel, meaning that in the long run, it might come back up and keep going. But what I see happening now, and I'm not a psychic, but I got a little experience. So this is what I see probably gonna happen. I can see something like this. Boom, we at the top of the channel, come back down, and it's gonna go again. Let me do something right quick. Gotta hurry up. I gotta start putting time on this thing. All right. So what's gonna happen is gonna do something like this. It's gonna come down, and then once it get in this zone right here, it's gonna do the same thing again. So what you can do, if you like it, pay you 2100, sell a 30-day call against it. When this thing pull back to around about $19, sell it, right? I mean, go ahead and buy those contracts back. What the hell? Go ahead and buy those contracts back and then let it ride back up. I wouldn't sell cover calls right here. Well, you could, but I'll expect for a bounce. All right, man. Hopefully you know what cover calls are. Hopefully now y'all know what ITM stand for, in the money, OTM out of the money. Hopefully you know what they mean when they say buy a contract. It's like you buying a lease option contract to buy a house. It's the same concept. All you gotta do is think about houses and you good. Oh, check this out, Bode. When I was looking at it on the phone, sometimes you gotta zoom out so you can see something. This is what I see. Let me show y'all what I see. Let me show you a trick right quick. You can go in here. Sometimes the candlestick could be all over the place. So basically, if you going back to the book, if you look at the book, you're gonna see something that looks like this. I told y'all the two main thing I told y'all where I make a lot of money off of is what you call the head and shoulder pattern. So it's like your head, boom, and bullish divergence. So Bode, you probably found something, man. I might just take the trade with you just to rock with you on this. I might just play with that. So you probably don't find your head and shoulders, man. And if you notice, based on the book, I tell y'all, once it get right here, this is like the head right here. These are the two shoulders. Normally the head will be longer, but you want the head to be a part of this divergence right here. And it's breaking to the upside, it don't broke through, now it could be taken off, right? So your next resistance level, Bode, would be bought right here. So if you got a chart and you're paying attention, if I was you, if you're trying to do a swing, look to get ready to have some resistance so you can take profits around $22.60. That'll be good. Let's see. Let's go back to the candles. Boom. Yup. Somewhere around there. And it should be good. Now that's on a daily. If you're trying to do something quick, let's look at it on a weekly chart. Oh man, you probably found something, man. Yeah, you know what? I'm gonna buy some with you, all right? I'm gonna go ahead and buy some of this with you just to see what it do. So look at what my man done found. He done found some bullish divergence over here. Boom. See that? That's going down. Check this out. RSI going up. This is, I ain't gonna say my bread and butter, but yeah, one of my main strategies. I think you found you one, Bode. I wouldn't hold it forever. I'll put me a stop loss. I'll put something down here showing that, hey man, if you fall in this zone area, if you fall in this zone right here, I will put me alert. I'm gonna show you how to do it. You right click on that area, on this line right here. Let's see. Right click and click on this bell, say make alert. I'm gonna say if it cross below this, let me know. I'm gonna say Bode stop. Uh, they need to close up. Either close out or buy some more. But if it come down here and it fall below this zone, I'll leave it alone because that means it probably gonna go to 5 or 6, and you don't want to hold it forever. So, bro, I hope I gave you enough info to make a good decision. Like I said, I'm gonna buy a couple of these shares just to rock with you. All right, man. I don't know how long this thing is, but damn, how I'm gonna be able to post that? How can I post that? All right, this is what I'm gonna do. I'm gonna put this on YouTube and send the link.